Good afternoon and welcome to the first in a series of ShareSoc Investing Masterclasses. My name is Karen Shorter and I am one of the directors of ShareSoc. I'll be hosting this afternoon's session, which will last for 90 minutes. The format of this masterclass will start with an overview of executive remuneration by fellow ShareSoc director Cliff Waite. And after Cliff's overview, we will have a panel discussion on the various remuneration issues relating to investment and what investors should consider. The last part of the masterclass will be a Q&A open to attendees. And I'm sure that most of you are very familiar with webinar formats. We are using Zoom software. And if you would like to ask a question, you should be able to see the Q&A bar at the bottom of your screen or to the right-hand side of your screen. The chat function for this webinar has been disabled. I'd now like to introduce you to the panel. Firstly, to Judith Mckenzie, who should be coming up on the screen. Hi, Judith. Judith is a partner and head of public equity at Downing LLP. Previously, Judith was a partner at Acuity Capital managing AIM, quoted VCT and IHT investments. Prior to Acuity, Judith spent 9 years as a senior investment manager with Aberdeen Asset Management Growth Capital as co-fund manager of the 5 Aberdeen VCTs focusing on technology and media investments. Judith is a non-executive director of the Quoted Companies Alliance and is an active member on boards both public and private. Thank you for joining us, Judith.
Thank you.
Our next panelist is Nick Naylor. He should be coming up on the screen too. Nick Naylor, hi. Nick is Chief Executive of Allenby Capital. Nick trained as a chartered accountant and since then he has acted as a corporate broker and investment banker at Credit Lyonnais, Robert Baird and Noble and Company. During his career, he has advised on a wide variety of companies with many transactions, including fundraisings, acquisitions and restructurings, and acting as a finance director to an online retailer. Our third panelist this evening, is Cliff Waite. Cliff is a ShareSoc director and has been investing in the stock market since 1984. He largely focuses now on smaller growth companies. Cliff was formerly a director at MM&K, one of the leading independent remuneration consultants, and he spent 30 years as a remuneration consultant advising FTSE 350s, small cap and AIM companies. Cliff is also the author of the Director's Remuneration Handbook. Welcome to you all. Unfortunately, Chris Spencer Phillips was supposed to be on the panel this evening. However, he is in hospital for a short period, but I know that actually he's listening in this evening. So we all wish you a very speedy recovery, Chris. But Chris did want me to mention that he's very passionate about good governance and good remuneration policies and commented that you can tell a lot about the true motivation of directors from their attitude to remuneration and whether they're really working for themselves or for their shareholders. So thank you, Nick, Cliff and Judith for joining the panel today. Your combined experience and expertise should make for a very interesting discussion. Amanda is our technical manager this evening. And Amanda, if you could go to the screen share view now. Before I hand over to Cliff for his presentation, I would like to introduce ShareSoc very briefly, as we have quite a few people attending this evening for the first time to a ShareSoc event. In fact, just to give you a size of the audience, we have about 250 people attending the masterclass today. ShareSoc is the Association for Individual Retail Investors in the UK. We are a not-for-profit organisation and work for your rights as individual investors in the UK stock market and for shareholder democracy. ShareSoc campaigns on issues where necessary, and we take matters to the various regulators, government or individual companies as we and or our members see fit. We also provide a lot of information on companies through company presentations. We hold in non-COVID times physical seminars, and we have in the past a lot of company visits. We have a very comprehensive monthly newsletter, many blogs, information about AGMs, and also information on remuneration reports. We strive to educate investors through masterclasses such as this, and also through the Invest Academy section on our website, really trying to improve the investing experience. And we also create networking opportunities through the online forums and seminars, and also through investor discussion groups. These are called Signet, and they're really a great opportunity to have small groups of investors come together to discuss various strategies. Next slide, please, Amanda. So this is the very important disclaimer. Obviously, as I said before, we are a not-for-profit entity. All the directors are volunteers, and we do not provide any investment advice. So if any company names come up this evening as part of the masterclass, they are for example purposes only, and they are not buy or sell recommendations. And we do encourage investors to do their own research prior to making investments. So I'd now like to hand over to Cliff for his presentation on remuneration. Cliff, over to you.
Good evening. Welcome to you all. I'm going to talk about what a good remuneration policy looks like. Next slide, please. Remuneration helps you decide whether to buy, sell or hold a share. So today we'll help you understand remuneration, help you complain about any companies if you're not happy. It will help you improve your investing performance. And I should say in summary that we've developed two sets of guidelines, one for large companies and one for small companies. And the links are here, and we will be emailing you the links to these guidelines afterwards. Next slide, please. First, a bit of history. Back in the 1970s, we had a 3-day week, power cuts, strikes, an oil crisis. We went with a begging bowl to the IMF. We had 83% income tax, which stifled any innovation and growth. The FTSE 30 index, that was the pre-runner of the FTSE 100, it lost 73% of its value, and the Dow lost 45%. So as is now, there's a divergence of the US and the UK, and the US doing relatively better than the UK. In 1984, Margaret Thatcher and her Chancellor, Nigel Lawson, introduced executive share options with a tax advantage to incentivize directors of companies, and they were subject to capital gains tax at the rate of 30% rather than income tax. Also in the 80s, there was a lot of privatization. Following the nationalization of the 1940s and 50s and 60s, this was reversed. We needed to incentivize the managers of those companies. They were privatized and they were given lots of shares to incentivize them. The tax breaks have gradually got removed for nearly everyone except for private equity. There have also been huge changes to defined benefit schemes, which defined benefits was the way that most people got rich working for large companies. And now that's no longer the case. You get paid via shares if you're successful. Another big factor which changed things was the dot-com bubble. There were many people who left large companies to set up or join small startup dot-com companies, and they were awarded share options to join those companies. Many became millionaires, and that changed the ethos of companies. And it meant that people wanted to make significant amounts of money from being employed in a company. 9/11 was another big factor, shook things up. The global financial crisis, 2007-8, that was another big factor, really caused, to quite a large degree by incentives. People were incentivized to sell improper financial products. And they followed the incentives and they over-leveraged companies, and we had the consequences of that. And then well, we've seen income tax came down to 40%, then it went up to 52%, that's 50 plus 2% national insurance, and currently the top rate's 47%. So next slide, please. So that's the background to where we are. And when we come on to the thinking about remuneration, I take the view that it all starts at the top. When the CEO is appointed, a deal is done, which involves both a legal contract and a psychological contract between the chief executive and the directors of the board. The psychological contract runs along these lines. We want you to come and join our company and do these things. If you do them well, then the share price will go up and you will be rewarded handsomely. Implicit in this is the agreement that the board will make sure that capital is available for investment and acquisitions. And also that if things do not work out, the CEO will be asked to leave. Such is the nature of life in the boardroom. What follows is the legal contract of how the X million of reward will be delivered, how much in salary, pension, bonus, incentives and shares, and what performance conditions and what compensation in the event the CEO leaves. So when we appoint the chief executive, we ask ourselves, what sort of person do we need? On the one hand, is this an entrepreneur who's really going to drive and lead and shake up this company? Or is this more of a stewardship role to look after the company, partly as a team of people at the top who are working together, looking after the assets and making sure we're making optimal strategic choices? Depends on the strategy, and it's the strategy which determines the remuneration. Next slide, please. For large companies, our guidelines really concluded that could probably find people who would be willing to do the job of chief executive of these large companies for half the current rates of pay. There doesn't seem to be a shortage of candidates. We don't all have to be a superstar to run these companies. Don't get me wrong, you have to be very, very good and very, very able to be able to run a large FTSE 100 company. It's a highly skilled job, but there are a lot of people who can do it. It's rather different to being centre forward for England. Very few can do that. Pay, we think, should be half the current levels. Maximum bonus should be 100% of salary. Don't want to over-incentivise annual bonuses because they tend to be achieved and they tend to be paid for the wrong things. They tend to be short-term rather than long-term. Maximum LTIP, we think, enough. 100% of salary is enough. There's been quite a lot of remuneration creep. It needs to be reversed. Remuneration committees need to do their job better. And a meaningful part must be in share incentives, and the shares should be kept for the tenure of the director, and preferably for a couple of years after they leave. Make sure there's no legacy problems. Next slide, let's have an example. A very current example is a picture of what was on my FT the other day on my screen. Number of different issues at the top, but Ashmore's the key one here. 30% of people were objecting, shareholders were objecting to the chief executive remuneration package of $4.7 million. That's £3 to £4 million. And that is a large rate of objection. However, if we look at the next slide, then we see how much really good fund managers get. These sums are enormous. And so again, it comes down to the question of what are we asking the Chief Executive of Ashmore to do? Are we expecting him to be a superstar fund manager or to be a steward of our investments? Another example I'll talk you through is of Persimmon. Persimmon in 2012 introduced a new incentive scheme and gave about 12% of the company to a group of 150 managers. Some people said it was too generous. I was one of those, but the investors approved it by well over 90% of the institutional investors approved that scheme. If we then sort of swing on for about 6 years, there was absolute furore when the chief executive was found to be in line for a £100 million payout. It's different between the US and the UK. In the US, they laud and celebrate success. In the UK, it's time for whinging and complaint. For Persimmon, it was a PR disaster. There was, the chairman had to leave, the Remuneration Committee chairman had to leave. Chief executive survived a little bit longer, but then there's a new chairman approved appointed, and subsequently the chief executive had to leave as well. And the person who replaced him, one of the existing executive directors, he's now left, and they've recruited somebody externally at a 30th of the rate of pay of the previous chief executive. It's had a huge negative impact on the brand. I bought my shares at £6 a share, and to me it was a no-brainer because they were so heavily incentivized, they were going to achieve these targets. And there's a great danger in the building industry that they buy too much land and they buy it at the top of the cycle. And this scheme was incentivizing them not to do that. They had to make capital repayments according to a schedule. And they did achieve those capital repayments, and the share price went up handsomely to over £30, I think. And I sold out about 27 quid. So that's the Persimmon example of how sometimes incentive schemes work, but they work too well. And one of the knock-on effects of this is, of course, every other FTSE chief executive wants to be paid the same amount. So the whole cost of paying chief executive goes up. And who pays for the chief executives? Well, it's the shareholders. You can either have to pay. The money which comes in either gets put to the employees at the lower levels, or it goes to the top executives, or it goes to the shareholders. We've effectively had to pay that little bit extra. Next slide, please. Can we have the next slide, please? So that was a big company example, a couple of big company examples. Let's talk about smaller companies. We've got guidelines for smaller companies. These are based on the QCA remuneration guidelines. That we're a bit more specific on our guidance of levels of pay for salary. Next slide, please. The remuneration, we think, should be focused on shares. Skin in the game is important, we think, to the investment process. We want alignment to long-term shareholders. Founders, often they own very significant stakes, and so that they've already got that alignment. Employees, when you appoint people from outside, then, we like them to have meaningful stakes. Sometimes they can't afford to buy it themselves, so they need options to actually get that alignment. Next slide, please. And when you're thinking about share incentives, you're saying, well, how much might the share price go up? how much incentive is really necessary, requires some modelling. And then the dilution, well, we feel that about 10% dilution of the equity over a 10-year period is probably adequate, maybe cases when a bit more might be required. Front-ended, but don't forget to reserve some for top-ups and for new recruits. And typically a structure will work with, say, 2% for the chief executive, 3% for the other directors, that's 5%. That gives you a little bit less left to spread to the next tiers down, if necessary, and for new recruits as well. Next slide, please. Very important it is to model the outcomes, and it doesn't have to be 24 pages of complicated algorithms. A little chart like this will do the job. So if you had a market cap at the start of 10 million, say, and the share price did really super and it went up 5 times, 10% dilution means you get 4 million for the management team. 4 million for a team of a small company like that is a huge amount of money, and that should be adequate to incentivize them. Thank you. Question I always get asked is about LTIPs or options. Which should one do? We don't really like options. Sorry, I'll start again. We don't like LTIPs. They are complex, and LTIPs also, they provide too much downside for reward because the share price can go down, but LTIP still has some value. That's not the incentive which we want. We're looking for growth companies where companies' share price grows. Why would we want to actually pay out if the share price was declining? Don't forget, I'm talking at the moment about small companies. In very, very large companies or mature companies which are in a run-off mode, then there may be an argument that you need to retain executives and that LTIPs or restricted shares may be the best approach, but not for small growth companies. And options are simple and clear incentive in our view. Next slide, please. Well, salaries. We did some modelling about what's reasonable, and this is the data. This is a good guideline. There's a bit more data in our report with quartiles on it as well, but that shows at least what's reasonable. It enables you to go back and say to the company and complain if you find that the chief executive is paid way out of line with these numbers. And that's actually what we did at RTC. David Stredder, he phoned me up one day and he said, have a look at RTC. What do you think about how much the chief executive is paid? And so I had a look and I phoned him back a couple of days later. I said, I think he's paid too much. He said, right, so do I. Let's go to the AGM, buy some shares, Cliff, and we'll go to the AGM and we'll talk and we'll ask some questions. So we went along to the AGM and we asked some questions. We had a chat with the chairman afterwards as well. And we got the clear message across. We thought it was they were being too generous, and they were given warning that we were going to come back the next year as well, unless they did something. That's how to complain. Next slide, please. Bonuses. Bonuses, well, if you're a fast growth company, you want to try to conserve cash and you want to give the image, well, you want to demonstrate to all your employees that you are conserving cash and you want to keep costs tightly under control. So paying big bonuses are not really consistent with that. And anyway, with other companies, rewarded management through equity incentives. Once a company is profitable, a bonus may be appropriate. When I say may, I don't see why it should be more than 100% of salary. 50% is probably sufficient in many cases. And if it is going to be paid, then pay it in shares is preferable. What we want to do is to grow the skin in the game. Another example I want to give is about impacts, asset management. This is a lovely company in a really sweet sector of environmental and sustainability issues. And they came and presented to ShareSoc in 2017. And I had a look at their remuneration, and I thought this is a company which is paying its chief executive okay. It's currently paying chief executive 220,000 salary with a market cap of 500 million. That's not unreasonable at all. It's built up over time, bonus. So, okay, yes, the chief executive did get paid £1 million last year. And he, more importantly, he owns £50 million of shares. To me, that's the right sort of alignment. That's the sort of company I want to be invested in, paying 220,000 salary and 50 million of shares. That gets the alignment the way I want to be in. And I've made a very substantial gain by investing in that company. And I'm still invested. Another one is a Flow Group. They came and presented to ShareSoc, I think in 2016. And it was all very, very good, so it sounded. It was one of those fancy plans, great ideas, all sounded super. It's one of my early days of investing as after I retired. And I did have a look at the salary and the bonuses. I thought, well, that's a bit high. Well, actually, it's quite a lot high, I thought. But I was taken by the story and I invested. And of course, now it's worth absolutely zero. It's gone bust. So there's a couple of examples why you should always look at remuneration. The next slide, please. You've got to have solid foundations, whether you're building houses or remuneration structures. And you should be able to demonstrate that over 10 years, there's a graph of the share price going up. In that case, it's okay for remuneration to go up. If the remuneration's going up and the share price is going down, you've got a problem. That's why I want to see a 10-year graph, particularly for big companies. And the pay level, it should be reasonable, both in terms of pounds amount, but also what percentage of share of the revenue, of profits, of cash flow, of market cap, etc. The third pillar is to own significant amounts of shares. I'll keep repeating this, a very important point. And clarity and transparency. Mark Slater suggests that you should only have 2-page annual remuneration reports because you should be able to make it nice and clear and simple over 2 pages. I agree with this sentiment, but I think we do need a full details to really get to see what's going around. And good governance, you need to have independent non-executive directors on the remuneration committee. Where necessary, companies need to consult with their shareholders, and the disclosures have to be clear, should have voting. In companies don't have to have votes on remuneration, but best practice is that they should do so. So those are my pillars. And it'd be wrong for me not to mention COVID and the implications of it. What we saw early in the year was salary cuts for directors and senior executives where they were leading by example, saying we're all in this together. There were some notable companies where the chief executives and the other directors did not do so, or they were very slow to do so, or they were dragged kicking and screaming to accept a salary cut. This is not the way to behave. And I think they've realised that to some extent, but I am a little worried that now that some of the temporary salary cuts have now been reinstated. I don't think the corona situation is passed yet. The Dow may be at 28,500, but I'm not convinced that it's passed yet. COVID is horrid for those who've died, for the sick, the poor, the unemployed, and for those who lose or will lose their jobs and their income. It's wickedly brutal. That will be the impact of COVID. And there may well be a backlash as a result of that on egregious pay. And I think this is an area where it affects the brand image as well. So it's very important that companies and their directors and their non-executive directors on the Remuneration Committee consider this very carefully. And that leads us to the panel discussion. So I'll now hand back to Karen. There are the links there to our guidelines.
Thank you very much, Cliff. That was a very informative overview and raises a lot of issues. Amanda, if we're able to get the panel up, I would like to, for this part of the masterclass, we'll be discussing various issues as a follow-on from the presentation. And really to start off with the issue of who sets the senior executive remuneration. The board, obviously, and the Remuneration Committee, often referred to as REMCO. And how effective do the panel feel about boards and non-executive directors when setting executive remuneration? Perhaps Nick, if you would like to start off on that one, you know, if you can really give some comments about that and how effective you feel they are.
Thank you, Karen. That's yes, I'm very happy to take that. Just before I answer the question or give my thoughts on the question, just a bit of background about Allenby Capital. We are a nominated advisor and broker. We act for about 65 quoted companies, all of them in the small cap space, the sub £200 million market cap section that Cliff referred to earlier. And we're predominantly nomad to AIM listed companies and broker, but we do have a number of companies on AQSE that we act for and on the standard list. So we have a broad experience of acting for a variety of companies at the various stages of their developments. And I think when it comes to remuneration, you know, there always used to be an adage that you didn't want to be the chairman of the audit committee when you were on a board because that's where you got all the flack at the AGM. I think in the last 15 years, that's completely reversed. And most non-executive directors I know would love to be the chairman of the audit committee and not touch the remuneration committee, because that's where the press commentary comes from. That's where shareholder angst can be directed at. So who's responsible for it? It's obviously the board, but the board, I think, have to take advice. They have to consult with their significant shareholders, and Judith can talk more about that and the willingness of major shareholders. They should also consult with their advisors, be it the nomad or the broker, but recognizing that the nomad and the broker aren't remuneration specialists. We don't have the data necessarily, we don't have the expertise, and in circumstances where it's likely to be difficult, I would advise boards to consult with remuneration specialists like MM&K, where Cliff was a director for many years, because they have that expertise. We're asking boards and particularly chairs of remuneration committees to bring a level of expertise that they don't necessarily have as a consequence of their previous business experience. And so I think that you know, boards do it, but it's important they consult widely. And we as Nomad are always happy to be consulted to give our thoughts, but we give it from the point of view that we're not a specialist remuneration consultant, and that's something the board should think about engaging with.
Judith, what would your views be?
Well, I suppose I know what my views are, but I think I know what sometimes the reality is as well. And it seems to be that it's done remuneration set in a dark room with a dartboard, because there sometimes is no correlation between what we can see as shareholders as what the strategic goals are and should be of the company, and what might be written within the report and accounts, and then tallying that back to the remuneration of the key members. I think you know, you touched on a few points there, and so was Nick. I think the shareholders should be consulted. I don't think that happens enough. I think that the nomination and the remuneration appointment on the board tends to be, or certainly has historically been, there for the person that wasn't the audit chair and just got thrown at the other person that was left. I think, fortunately, that is changing. And, dare I say it, good old ESG is changing the way that fund managers have to think. We're under quite a lot of pressure from our investors to think about how governance and in particular remuneration forms part of our own decision making, and therefore we're being asked much more to have an influence in those decisions. So I think that's a really good thing. It's maybe for me coming a little bit too late, because I think there has been in the past, I'm being negative here, but I think in the past there's been an inclination to run to the consultants. I'm not saying the consultants are doing a bad job by any means. I wouldn't say that, Cliff, ever. But at the same time, I think sometimes the consultants that are being asked the question are being asked the question by the wrong people. It's almost as a justification to put remuneration in that sometimes looks a little bit toppy. So again, you're looking for quite a lot of independence out of our remuneration committee director, and sometimes especially in smaller companies, that line gets blurred a little bit too much. But as I say, the great thing is I think there's far more accountability coming in. Shareholders like us have to step up to the mark and engage and show that we want to engage, and companies have to be probably quite a lot clearer within their report and accounts, because that's what we're going to be asking for.
Thank you. And I mean, do you feel obviously the remuneration committee perhaps needs to have a broader group of people sitting on it, a broader discussion to create a better incentive plan? But do you feel that then for the remuneration of the chairman, of the NEDs, of the independent directors, how does that play in the mix?
Well, there is obviously debate, and I don't really have a firm view on this, but there's debate as to whether there should be wider stakeholder engagement, and that includes employees sitting on advisory committees or committees that look at remuneration. I think that's a bit of a thorny issue. It's probably quite difficult to deal with in smaller companies as well. However, I do think that there should be, again, a correlation between the profitability of the company, the employees, and what the chief exec is walking away with at the end of the day. So I think that stakeholder engagement right the way through the ranks is quite important. How that's carried out, I'm still not quite sure yet, to be honest.
Cliff, would you have any views on that?
Yeah, I think you should get the CEO right. They've got to lead and motivate the organisation. They've got to set the culture of the organisation as well. And if they're paid £50 million and the average pay of the organisation is 22,000, that might not be the right culture for that organisation. So I think you start by looking at the chief executive's pay, and that's most of my focus. 90% plus, I think. Get that right, it all follows on.
And then how can individual shareholders elevate executive pay matters if they have a concern? Judith, you mentioned sort of shareholder engagement. Are AGMs the best way? What would be your view on that? Perhaps Nick, I don't know if you've got any comments there.
I'll let Judith go first.
Thanks, Nick. Yeah, I would just shout, and AGMs are the best forum to do it. But at the same time, any decent chairman, REMCOM chairman should be available to any shareholder, not just the institutions, but any shareholder. And it's amazing how much, well, sometimes, how much of an effect just being a bit of a nag and pointing out the basics and what you believe is fair and being consistent in that message can make a difference. Sadly, sometimes that gets ignored, and that tells me more about a company than anything else. So in those situations, sadly, I have to vote with my feet, but I would always make it very, very clear as to what our views were before we went for the exit.
Yeah, I would agree that the AGM is obviously the natural forum that shareholders can engage face-to-face with the board. I think one of the benefits of COVID, and there are very few of them, I'm afraid, has been that companies have engaged, perhaps moved more through Zoom and through our remote engagement with shareholders through some of these new platforms that are coming, like Investor Meet. And I think, you know, if investors are on those, they shouldn't be afraid to raise remuneration questions there. I know there's always a danger that, rather like today, the questions are being screened before they're being answered. But I think one way not to deal with it is to go for the company's nomad and make a lot of noise saying that the board are paid too much, and that's a breach of the AIM rules, because it's the regulation. The AIM rules don't really cover remuneration. There are rules about if director remuneration is sort of outside usual parameters, then it may be required to be treated under the related party rules. But to just scream and shout at the advisors generally doesn't get the way forward. I think it's trying to engage with the company at the AGM through the forums and directly with chairman. And again, I would echo Judith's thought that chairman should be available to speak to shareholders and engage with them, and that includes on remuneration matters.
And I got some specific suggestions. Send a copy of the Remuneration Committee guide, ShareSoc's Remuneration Guide, to the company, along with your view about what you think is actually wrong. Companies are very good at answering shareholder questions. I'm quite surprised how, if you write a polite email to the investor relations people or send it to the chairman, you will get a response from 90% of companies. There are a few companies who don't, and that's probably a sales signal as well, actually, if they should treat you with that disdain. I'm amazed how effective that is. Secondly, actually go to the AGM and ask a question. I find it's much better if I write to the company secretary a few days beforehand to give them a copy of my question. I then know that they're going to have thought through the answer, because the company secretary prepares answers to all the questions which are going to be raised at the AGM. And most companies take their AGMs very, very seriously, and any known questions they will prepare and rehearse for. And you find very often when you go to the AGM, having written in the question, they're looking out for you, and you get a chance to chat to the company secretary, HR director, and sometimes the chairman themselves. And my other tip is talk to the Remuneration Committee chairman after the AGM. Over a lunch or a glass of wine, there usually something happens over those lovely old-fashioned physical AGMs before we went to the current approach. I did this at Berkeley Homes, and Tony Pidgley shut the AGM down before I had a chance to ask my question, but I actually managed to talk to the Remuneration Committee chairman for 15 minutes on a one-to-one basis, which was really helpful. So there's 3 steps for people to learn how to object, campaign, or just get your views across.
Maybe I could re-emphasize Cliff's final point. I find a lot of client AGMs I go to that everyone's a bit reserved during the formal part of the meeting. They're a bit on show, but actually when the meeting's finished and there's coffee afterwards or whatever, they can be much more open with individuals. So I would encourage you to try and engage on a more personal level with board members after the AGM. Thank you.
Moving on to just understanding a little bit better about institutional investors and the ISS recommendations sometimes to institutional investors, and what, to what level institutional investors engage with companies regards remuneration prior to investing. I mean, I know there's obviously, Judith, as you said, more emphasis on ESG. Could you just maybe explain a little bit more of that process?
I think we might be a wee bit different. So we take strategic stakes in smaller companies, and we maybe only have 20, 25 positions, whereas another fund manager would have 200 positions. So we look, part of our DD process, our diligence process is looking at the overall remuneration structure. And actually, sometimes it can be an opportunity when you see that something is a little bit out of kilter, and actually you might be able to get involved and help the company to put what might be better practice in place. It is a bit of a minefield, but that's something that is one of the tools in our toolbox as a fund manager. So we're a little bit different. We would never outsource a decision for voting at an AGM to any other third party. Every one of our fund managers has got a responsibility to vote personally on behalf of their fund for the companies that we're invested in. So I think that's really important, and it actually makes you pretty sharp to some of the issues that that can come about. So I suppose our level of engagement is slightly different, or we hope is slightly different to maybe some of the mainstream. But I do understand why, if you've got 300 companies in your portfolio, you are likely to outsource to ISS. And I think their guidelines are really quite sensible. You know, they're looking for material long-term investment in the shares of the company from the management team. That's obviously something we would support. They're looking for alignment with the longer-term strategy. They're saying that boards should be able to use discretion, and that there should be regular discussions with shareholders. So all these things are sensible, but sometimes I feel as though it's a bit of a box ticking exercise, because they're just taking the report accounts. They're maybe not taking the previous 5 or 10 years report accounts. They're taking one set, and they're looking for sort of probably keywords within that remuneration report that they can sign off on or not, as the case may be. So I think the principles are very good from ISS. I think in practice you've got to have knowledge of the company and be able to apply a bit of common sense around about it, which is probably quite difficult to do when you're doing thousands of companies a day.
Yeah, if you've got 40,000 companies in your universe, which BlackRock would have, you need a filter. And that's what ISS are doing. They're providing a filter, which are the really bad cases, which the fund managers of BlackRock have to look at. And so there does need to be something. But there are some fund managers who hide behind the ISS recommendations. And it's a particular problem in the US as well. It's become a cottage industry, and as Judith says, there's box ticking. And I liked your point about 1 year rather than looking at 10 years. That's a long way to look at these things. You can't actually tell the answer on a 1 year basis. That's why I'm so fond of 10-year runs of data. Yeah,
I think what's slightly annoying for shareholders like yourselves, and there are quite a few of us out there, if we do take these things seriously, is that when you come across something that you feel is not fair, then you try and have a conversation with another shareholder to give your views, not to try and influence. And the stock answer is that actually they can't engage in any way at all. They can't even listen to our view because it's being done by a third party and they've already cast a vote. So you then end up just going down an alley where you've sometimes got a management team that are shrugging their shoulders and smiling, knowing fine that you can't touch them. So that can get quite frustrating. But again, I think this whole topic is becoming far more significant and relevant. Well, it's always been relevant, it's always been significant, but people are paying attention to it because we're all accountable. Everybody in that whole ecosystem is now being held accountable, which will make people, fund managers like us, react accordingly, I hope.
And in these current times, obviously with COVID, what are the implications on remuneration? I know Cliff touched on them towards the end of his presentation, but how do you see this playing out in the long run? It's shaking things up, bonus targets not being met and so forth. What are your views on that and the implications? Nick, would you like to?
I mean, COVID has obviously had a massive impact on everything, and we're about to see further restrictions imposed on other parts, on certain parts of the United Kingdom, and it's had a big impact on businesses. And Cliff was right that when COVID first broke, there were a number of companies where boards, very publicly stated they were taking action. I think a number of companies have quietly dropped that and pushed executive remuneration back up to normal levels, even though we're well out of COVID. It's a balance, isn't it? Shareholders have lost money, so why should managers be remunerated? But at the same time, on the other side, performance, bonus schemes have to be rebased to incentivize management to rebuild value for the business. And we need to make sure we don't have a culture of heads management win, tails shareholders lose, and it's done in a balanced way. So that is where I think engagement between remuneration committees and key stakeholders, that includes shareholders but other stakeholders, is very important in setting management remuneration and chief executive remuneration, where there may need to be rebasing or it may not be appropriate to rebase. And I think that is in particular going to have to be done on a case-by-case basis.
Yeah, I'd agree, case by case, because I mean, some businesses just mothballed their business; they just can't operate. Some are bad businesses, and Tesco is fine, and we get our weekly delivery. They're all right, and some businesses are good. And when it comes to, I mean, if you're in pharmaceuticals, you're probably well, it's actually been positive, many of the small pharmaceutical companies. And so why should they have a pay cut?
Yeah.
It's not appropriate. So yeah, it's a segmentation problem. Yeah,
I think I tend to look at, dare I say it, I don't look at share prices. That sounds a strange thing for a fund manager to say, but we believe that the destiny of the share price ultimately is going to come from earnings. So we've tried to sort of look at companies and see ways through COVID. Some that are just going to be zombie for quite a while. Others where actually structurally their business model is shot, unfortunately, and actually you can't even, when you're looking at survivability and a look through, what we call it an earnings look through on COVID, which is a very difficult thing to do, but with some of these companies we just don't think are going to be at the other end. And then you've got companies that are hopefully doing all the right things, reacting in the right way, cutting their cloth, and that includes their own salaries, but also cutting needless costs within the business, and really looking to survive for the long term, and hopefully having a product or service that will be required at the other end of things, whenever that is. And I think you've got to treat each one of those companies differently and look at the incentives of these companies and management teams in a completely different way. Because in some cases, I suspect we'll be looking at a full-on turnaround, and we'll have to almost forget the earnings that we had before and the share prices that were there before as well. And then in other cases, actually, as you say, they've been benefiting from the COVID situation. So it really is on a case-by-case basis.
Yeah, and if I could just add, there's quite a lot of recovery shares there where they've lost a lot of their value. They're now over-leveraged. It may well be that there's a chance here that these shares will recover quite hugely as well. A lot of them will go bust. What I've seen, though, is a number of chief executives who may have admitted to themselves they've been putting off making decisions, tough decisions. COVID has forced them to reassess businesses which they decide are no longer viable, or divisions they've got to shut down, factories they've got to close, it's really provided a focus for them. And so there are lots of opportunities out there. We mustn't forget that. We need to find ways to get capital in there for these companies with opportunities. That's why we had our response on capital gains tax to the government, so we don't get money all tied up in AstraZeneca.
Thank you. We're going to move on to the attendees queue questions, of which we've got quite a few coming through, and I think they will prove very interesting. Just before we move on to the general attendees questions, I'd like to remind everybody about ShareSoc, and obviously to become and encourage individuals to become a member of ShareSoc. You get for a small £45 a year, you get a lot of information, a lot of access to events such as this. And so we really hope that those who are new to ShareSoc this evening will consider the membership. Just moving on to attendees' questions, and I'd like to start off with this one just because it's coming from a slightly different angle. This person says that a key issue seems to have been missed, and that intrinsic value of the business versus the shareholder value, and that the intrinsic value of a company and remuneration should be tied to that and not just the share price. The share price can be manipulated in the short term, by share repurchases, for example. So I really just wanted to get the panel's thoughts on that.
This is probably where I might disagree with the ShareSoc to a certain extent, and I know that you're keen to keep options simple and tied to TSR, and not really look at hurdles for triggering of options. My view is different, and I suppose the premise of it is that small cap markets, micro cap markets are terribly inefficient. And sometimes, even if you do everything right, the share price can still be kicking along the bottom somewhere. So I would far rather see our management teams incentivized on what they can deliver, and that is asset allocation, capital allocation within the business, return on invested capital, and the metrics that hopefully drive the underlying earnings of the business. So I would always like them tied to something that is a tangible earnings-based deliverable, as opposed to a share price. That might be controversial.
Cliff, have you got thoughts on that?
Well,
it has come up, and as a number of attendees have asked this question, obviously, because share prices can be manipulated. What would your thoughts be?
I think that it's difficult to manipulate the share price over the long term. And that's why I say that it's important that the chief executive holds his shares for the tenure of for the full tenure of his job, and doesn't sort of sell them after 3 years. That's one of the questions which somebody's asked about. And preferably they hold them a couple of years after they retire, because too often we find that the chief executives retire. We thought he was wonderful, and a couple of years later, it's not so good. Lord Brown, BP, being an example. 14 years, he was the sun god and great. So that's the answer at the chief executive level. Options at the next level down, as opposed to LTIPs, as opposed to restricted shares. In a number of cases, when I was a remuneration consultant, we put in restricted shares at lower levels, because people began to view options as a ticket to a lottery, and they weren't able to influence the share price to the same extent. They found that the shares actually were better. They built up a long-term view of the company as they slowly grew their number of shares they owned.
We've got quite a few questions coming through about LTIPs as well, and the disclosure of LTIPs. And I think, Cliff, you mentioned in your presentation that they should be no more or equal to 100% of the salary. But I'll just read out a few of these questions so that we can get a feel for them. So when setting performance targets for LTIPs, companies often refuse to disclose the actual targets on the grounds they are commercially sensitive, and it would be detrimental to the interests of the company to disclose them. Is this really justifiable? And we have a comment also that more and more AIM companies are seeking approval for their LTIPs and remuneration policies, which is good governance practice. Should that be a formal requirement? Either in the QCA guidelines or even perhaps for ShareSoc guidelines. And just generally then, companies do not seem to be explicit about how they fund share awards in their annual reports. So we can see some themes there, and just looking for your comments to those.
So I take the disclosure. I mean, the disclosure of, I don't like this, it's commercially sensitive, we shouldn't disclose it point. I think it's a very easy refuge for companies not to disclose. And to be fair, the AIM rules, which govern AIM companies, are generally pretty unsympathetic to it's commercially sensitive, we can't disclose it. Unfortunately, there aren't specific requirements within the AIM rules for disclosure about LTIP performance criteria, other than a general obligation of disclosure, and it's irrelevant and price sensitive. We would always advise the client to the company to be more fulsome in the disclosure, because as it links to what Judith was saying earlier about it gives people an idea of the strategy and the direction that the company are looking to go in, and gives the the shareholders an idea of the metrics that a management team are being measured on, and presumably those metrics are linked to the company's strategy. So I can't see it being a negative to disclosing it there. The second point about, should there be more requirement for disclosure of new share schemes, that requirement could come at two levels: one within guidelines being issued by the QCA or ShareSoc, which aren't binding on a company, or would it become a requirement to the AIM rules or the listing rules for quoted companies, or the aqueous rules for companies putting in share schemes to get disclosure. My conversations with the regulators in the past they've always shied away from this, saying they don't want to be too prescriptive. It's it's an entrepreneurial market. It's about having lower levels of requirements than the main market. But maybe as the remuneration debate does come more to the forefront, and echoing Judith's point about this becoming a bigger issue now, maybe it's time that the regulators to look at this and said we have to be more proactive in this area. Their view has traditionally been it's not really an area we want to be regulating. We want to let companies get on and deal with it, with their shareholders directly.
Actually, I can maybe get some free advice here from you two, because some of the situations where I've been involved with in the past, where the disclosure has probably been a bit light, if I was to look at it externally, it's where we might have got involved with a company where the clear best outcome for all stakeholders would be a trade exit at some stage over a couple of years. And in typical private equity style, you would incentivize the management team to achieve that exit, and you would have levels at which the realization or capital back to shareholders would trigger a payment to the exec team. How would you recommend disclosure in that case? Because obviously, if you're putting that level of almost like ratchet detail into a disclosure, you're basically saying, well, come and get me at whatever price, and you're almost putting a base on the price that the company could achieve an exit at. Is there any sort of deviation away from what maybe is best practice in that type of situation?
I think in those situations, this is what the board at the moment in time, when they're putting in place the scheme, think it should be something for companies to target. There's a company we act for called Blackbird that have a scheme in place that if a valuation is achieved of X or Y, then management end up with a certain percentage of that between them, and that was all fully disclosed. It was approved by shareholders, and copies of that scheme are on the company's article, on the company's website for people to look at. So I don't think it's a positive. And it may fit the unique circumstances of that company, but I don't think companies should shy away from that. Look, if the base is set so low, then the scheme shouldn't be in place in the first place. You need to make these aggressive targets to achieve.
If you're afraid to disclose the scheme, then you need a better scheme, and you probably need better remuneration consultants.
Thank you. Thanks, Cliff.
Yeah,
I think there's an interesting balance here, because you've got a strategy, which is, in this example, that they do want to sell. So you're actually announcing that is part of your strategy. There's nothing wrong with that strategy. It's a good strategy. It's clear. And if you're saying, well, we're willing to pay this much if we go early, that's fine. And if you can defend that and it's logical, you should be able to put it into your annual report. I think a lot of this commercial disclosure stuff, I think, is actually, well, I'd say it's rubbish. But the thing is that a lot of people are hiding behind this, and there's a lot of lawyers who are advising company boards to not disclose this information on this commercial sensitivity issue. It's not commercial sensitive most of the cases. There's usually a forecast out there in the market by some analyst, and so people are aware of what the general intent of the company is. So I just find that there's too much sensitivity on this issue. There we are.
Thank you.
I mean, it is, you know, individuals' salaries and remuneration is a sensitive subject, and we've got a couple of questions coming regards Remco, and as somebody who states they're a chair of a Rem committee, and you know that he spends or she spends quite a lot of time on it without being remunerated any extra themselves, and trying to take and consult with different fund managers about remuneration, and finding that quite challenging. And then another attendee saying that the chair of remuneration committees rarely have their contact details visible to shareholders, and that they should be more accountable. So, you know, clearly at this sort of that board level, there seems to be quite a lot of issues coming through. It was on the first points that we discussed. How do you think this can be improved?
You're talking about remuneration committee chairmen not making themselves available. Well, I think that a filter through the company secretary is not unreasonable. Sadly, we live in a world where a lot of people make abusive comments online, and it's not appropriate, I think, nowadays for the remuneration committee chairman to put their details out there and expect to receive hundreds of abusive phone calls. It's a sad world we live in, but there's a filter through the company secretary, and if you've written a proper email thoughtfully, it will be answered, in my experience.
I think the other point I'd like to make, Cliff, is that we all have to accept there's no right answer in this debate. And what I see often is people getting terribly wound up just because someone has a different opinion to them. And we do have to learn to recognize that there isn't a right answer, that others may have different opinion, and our own views may not necessarily be the right views, but both sides, both on the company, who need to be less sensitive about discussing remuneration with shareholders, such as ShareSoc members, but also important on shareholders when engaging with companies on remuneration, to recognize they're not going to, they're not going to win the company over every time, that there will be differences of opinions here. So it's very important that the debate is conducted in a, as Cliff said, a thoughtful manner, rather than in a highly charged and emotional one where people are being, not remuneration committee chairs that are probably earning £35,000 a year are being hounded by shareholders because the chief executive bonus was 110%, not 100%.
My pet hate is people say earning when you should be saying paid. Sorry, Nick. But,
sorry, I apologise.
You could well be earning a lot more.
Another question is here, given the current uncertainty and increasing pace of change, what is the panel's view of the timescale of performance targets and the potential need for these to flex?
Yeah, if you look at all the recommendations, everybody says long term, which I agree with. But then when long term is interpreted by remuneration committees, it tends to be 2 to 3 years, and I don't think I don't think long term is 2 to 3 years, and I think especially now long term is going to have to be properly long term, because going back to the point that I made before about the kind of look through on earnings for COVID, we're not even a quarter of the way through it yet, and I think the market might have bounced. Share prices might have gone up and make people feel a bit better about life, but we're probably just about to go through one of the worst recessions that any of us will ever have gone through, and it's very difficult to I think put incentives in place at this juncture, specifically at this juncture, when you can't really have a proper look through as to how you want your chief execs to behave. So I think long term there's going to be a rewriting of what that definition is. It's going to have to be.
Part of our problem goes back to 1984 when the executive share options came into place, they were 3 to 10-year options, and people exercised their options as soon as they could. And in 1984, 1987, you remember what happened in October 1987? We always get a storm. We've got a new one coming on tomorrow, I think. All the trees blew over and the stock market went down 30% in one day. All the executives who hadn't exercised their options had suddenly found themselves a lot less rich than the ones who had. And that created a culture, a little cultural problem for many years afterwards. It should have been that you should have had phased vesting of options after 3 years, 5 years, and 7 years, say. And then people wouldn't have been able to exercise all in one go. And because once they exercised, they then demanded they got more.
Mm. Yes.
And were given more. So they exercised again 3 years later, got more, and demanded more, and on it went.
Yeah.
Yes, and there's, I guess, a related question here saying, would the panel support a max cap on the amount of share options that vest in a particular year, i.e. to prevent a person, or is that against shareholders' interest?
Yes, definitely, as generally, but there's always particular circumstances.
Yeah.
And we had another question in advance regards, there seems to be a bit of a cult of the messiah in the business world, the belief that there's someone out there that can solve all of a company's problems. And then, you know, an outsider is brought in at a very high cost level to sort of fix a company. And that the failure of not having good internal candidates for appointment is sort of a bit of a fundamental failure within the company. How often do you see that with external CEOs, CFOs coming in as opposed to internal candidates? What would your views be on that?
I mean, from our point of view, continuity is always good, but at the same time, sometimes continuity is bad because you need someone to shake up and take a different view at the business and the way its strategy is. And one of the things we're not massively fans of at Allenby is promoting the finance director to the CEO role. It can work, but generally, you know, you're just continuing the same regime often. I think one of the interesting things we're seeing is a lot more companies going overseas for, even at the small cap end, going overseas for chief executives in particular. And that brings its own remuneration challenges because you're bringing people in from overseas jurisdictions, potentially from the United States, and remuneration expectations are a lot higher in those circumstances. So it's a good company running well should be, every chief executive should be grooming his successor or her successor from the day they start their job. I don't think that happens very often, though.
Yeah, there should always be, I mean, a big company, 1 or 2 or even 3 potential successors. I mean, a small company, Nick, I think Nick and I would agree that you don't have that luxury. Your succession plan might just be, we're going to recruit externally. But in a big company, if they have to go outside, then they're going to find they have to pay a lot more than if they promote internally. And it usually upsets all the internal relativities as well. And at least 25% of external recruits fail, the data shows.
And we've got, again, a couple of questions relating to shareholder engagement and that shareholders need to take responsibility too, both individual shareholders and institutional shareholders, and a comment stating that institutional shareholders you know, don't attend AGMs enough. And I know, Judith, you'll operate in a slightly different way. But obviously this engagement is an issue and perhaps needs to be expanded upon.
Yeah, you know, I kind of need to apologise for our industry to a certain extent. But you know, even we will probably go to maybe about half of our AGMs. And I think, you know, this highlights a point, doesn't it? So how do I know if there is shareholder discord within the PI base? And I should know. And at the moment, really, and having worked with ShareSoc before, they've been pretty good and very vocal about telling me where situations they feel are unfair. And we take that on board, and hopefully it's viewed that we engage, and that we try and engage through events like Mellow and otherwise. But it's a good takeaway for us to actually think about not just going to the AGM to see the company, which we do anyway. We see the company pretty much whenever we want. But the value, I think, probably of seeing the other shareholders at the AGM is, something that we need to think about. And I think I can't see BlackRock doing it somehow, but at least we can do it.
Quarterly analyst meetings are the most important things for the institutional investors and analysts to go to. That's when the chief executive and the finance director tell them what's happening to the business. And those meetings should be open to all shareholders. That would be a huge step forward. And failure to do so means that the companies are not treating shareholders fairly, which is a requirement of the Companies Act, Section 172.
Do you not think that the COVID situation should change behaviours? So AGMs could be held in forums like this, and where everybody gets access, and you're not necessarily having to get on a train to get to wherever it is for 9 o'clock in the morning. So surely companies should start to be thinking how to engage with all stakeholders and make it easier for them. We've only seen, I think, a handful of companies that have actually used the AGM through the COVID situation to communicate better with shareholders through the AGM.
I think, Judith, most companies have used COVID as an excuse to silence the AGM. We can't have anyone turning up. We'll do it technically, and we'll promise a presentation to shareholders at some future point. And promises and actual delivery are rarely the same. So I would encourage you to use some of these forums like Investor Meet. I don't have a particular interest in them, but which are giving a forum for shareholders such as ShareSoc members to engage with companies. And I would encourage you to communicate directly with companies through the company secretary. As a shareholder of the company, it's your right to do so, particularly at a time where physical meetings aren't possible, like AGMs aren't possible.
On a slightly different note, we've got a question asking, what is an appropriate multiple for CEO pay versus staff remuneration?
20, according to Lord Hutton in his Hutton review, I think. And I think the John Lewis partnership operated on that until they had to recruit a new chief executive. And then they found it didn't work any longer. Goldman Sachs operate on about 80 because the average person in Goldman Sachs is paid $450,000 a year. Averages, of course, the average temperature is caused by putting your head in the oven and your feet in the refrigerator.
Yeah.
So they're not all paid $450,000. So it's and I think it's 1,200 is the ratio for the gold mine, because you've got a lot of people in South Africa or Southern Africa working in a gold mine who don't get paid very much because that's the going rate, and the chief executive is paid on a global pay scale. So it's not a great question.
Yeah, I think in a business where everyone is, like a biotech company where everyone is, highly qualified and paid more, it'll be different, as you say, from a resources company operating in a lesser or a developing country.
Not a great question, but a really good question. Please, can we see this ratio over 10 years for this company to see how it's changing and why you've suddenly decided that the chief executive should be paid a lot more relative to the people on the shop floor than it was 10 years ago?
I think that's much more interesting.
Yeah, but the FTSE is on 119 times. So, and it's been going in that direction pretty much for every year apart from the last 2 years. So we're being overpaid, basically. If you're using the FTSE, and the FTSE does tend to get used as a benchmark, albeit that discounted back, then it's still a massive problem that we're nobody, I don't think, has been really accountable for. And that comes back to shareholders, comes back to all stakeholders. And I think there's one question there saying, what one thing would you change? And I think it's that accountability aspect in the whole little life cycle that exists. And that includes, I think it very much includes fund managers.
Interesting also to come back to the point on AGMs, and I think it's been a bit mixed in the time of COVID of how much access companies are beginning through AGMs and with all the technology that we have. And for example, a webinar like this evening where you sort of think, oh, well, it could make it a lot easier, a lot more accessible. And how could that be improved? Because obviously if AGMs and perhaps if more nomads are insisting on virtual AGMs, then they have individual shareholders as well as institutional shareholders have the opportunity to ask the questions more directly.
Well, we've done a long campaign, lengthy campaign against Royal Bank of Scotland to have a shareholder committee, or really to improve shareholder engagement. And we've finally persuaded them to have a number of meetings with shareholders outside of the AGM. And then this year, of course, they couldn't have those, but they did virtual meetings instead. They started last November, actually, before COVID. And then they came along to their AGM, which they held on April the 30th, I think. And then they decided that votes had to be in 3 days before that AGM. Nobody was allowed to go to it. And they were to have a virtual shareholders meeting in July. So they got the sequencing wrong, and it was pretty basic. If they really think that voting is important. I think they just regard it as a formality, but it may be a formality 99% of the time, but on certain occasions it's not a formality, it's very important. And companies need to recognize this and therefore do it right all the time, rather than just when they're forced to.
Yeah, Karen, I'd say, I mean, the requirement for virtual AGMs has been driven by the COVID situation and the need for the meetings to be safe and social distancing rules and lockdown requirements, etc. But I think a number of companies that I speak to have actually found that engaging through forums like this with their shareholders has been quite enlightening and quite good. And they have to maintain some degree of control. They don't want it to become a complete shouting fest. But actually, provided shareholders engage, as Cliff said earlier, sensibly and constructively, then I think you'll find most companies are very happy to engage. Most head of remuneration committees are happy to engage in a constructive, open dialogue. And COVID has proved that it is a lot easier to communicate than we all thought in the past through electronic means.
I'm just mindful of time. It would be great to get from each of you a quick sort of closing summary of what you see as important for investors to consider on remuneration when making investments. Yeah. If we're happy to go through that, and then I will slowly wrap up the session. Judith, what would be your sort of key thoughts for investors to consider on remuneration?
I'm going to be a little bit repetitive, I'm afraid, but I think focusing on what kind of behaviour the incentive scheme that's in place generates. And for me, it shouldn't be short-term focus on a share price, but it should be on the key metrics that will drive the underlying value of that business. So going back to the boring things like cash flow, return on invested capital, and ultimately earnings. So I would always look for a correlation between the detail of the option scheme that's in place and those metrics tied to the overarching strategy of the business. And where is it going to be in 5 years' time, and how is it going to get there? And hopefully that you see that the option scheme that's in place helps drive that kind of behaviour. So it's really checking that correlation. I think things to avoid are snouts in the trough without actual equity shareholdings themselves. That's always a warning sign. And a reluctance to engage with any shareholder on these matters. We won't always agree necessarily, but there should always be a level of engagement. So those really are the key 3 things for me.
Thank you. Thank you. Nick, what was key?
Yeah, I mean, I would echo a lot what Judith said. I would also echo, of course, we do need to think of this from the other side perspective, not just the chief executive, but for those senior managers and other managers in the business. One has to recall that after the tax treatment of options, actually, there's very little often left over for individuals. I think the key thing for me, though, is that what I like to see is where senior management teams, chief executives, are putting some skin in the game themselves. So Judith talked about an equity share, but even there, what I really like, and a company called Franchise Brands has done this recently, where the grant of options was dependent upon those senior managers buying shares in the market and making market purchases, putting some of their own capital on the line, because for too long, the view of options has been that it's a one-way ticket for management. You know, if the business performs, they make out like bandits. If it doesn't perform, they don't lose anything. Some reinvestment of their own capital. And I appreciate for some people that can't be significant amounts of money because they haven't got that money. But I think that is something I would like to see a lot more of, and more of a phasing. So for every one option you're granted, you're buying a share in the market, or you're buying half a share in the market, or whatever. Because that, I think, can be really demonstrated some real belief in the business by the management team.
Yeah, thank you very much. And Cliff, your thoughts?
I'd echo a skin in the game point from Nick, and Judith's point about was transparency and clarity, really, measures, performance measures which reflect the strategy. And I would say download this from the ShareSoc website. It's not too thick. It gives some useful guidelines, and it summarizes some of the points we've made tonight. One size doesn't fit all. Reluctance to engage. I think we saw that with Edge Performance VCT. We campaigned strongly against them when they shareholders voted off 3 directors, and 2 were then immediately reappointed. And they were not willing to listen to our point that the management were overpaid in our view. There was a great reluctance to engage. It took a long time to persuade them to come to the the engagement table, not the negotiating table. And yet then examples like Royal Mail and Persimmon, they've actually come back to us now. They're keen to look at the individual investor viewpoint. And Boudica, one of the proxy agents, they routinely phone me up, and there's a controversial example now. I say, well, what do the individual investors think of this? So I think we're getting there. I think there are much fewer of these outliers, the really high-paid Martin Sorrells. Although, boo-hoo, 50 million for the chief executive.
No. Listen, thank you very much. Thank you very much to the panelists and to our sponsors, First Flight and Mello Virtual. If you enjoyed this masterclass, please join the sessions on private equity, ESG and short selling in November. For those of you who are not already ShareSoc members, we hope that you can see the value we provide and that you'll consider being a member. There will be a feedback form emailed after this session. Do fill that in so that we can improve what we do. Many thanks again to the panel, to Judith Mckenzie, Nick Naylor and Cliff Waite. Thank you for your time and all your input this evening. And to everybody attending, thank you, and look forward to seeing you at another ShareSoc event soon.